Welcome to the Tax Law Channel here on the Legal Broadcast Network with my guest, Robert W. Wood, a tax law expert with Wood LLP in San Francisco, is writing in Forbes about the Katie Holmes, Tom Cruise divorce, Scientology, and how all this relates to taxation. Rob, in divorce cases, how do taxes typically apply?
You know, it's funny. I guess from my perspective, I see these as relatively simple rules, and yet, and I would hope that celebrities, people that have lots and lots of money, as certainly Tom Cruise does, and Katie Holmes, I guess, has a reasonably sizable amount of money too, and probably soon to have more. I would hope they don't make mistakes, but I can tell you that the vast bulk of people out there oftentimes get this wrong, even, surprisingly, when they have professional help. So I guess there are a couple of fundamental rules. The most fundamental rule, and I think this is what causes a lot of the problems, is Section 1041 of the Internal Revenue Code, which basically says transfers between spouses or during marriage or on the cessation of marriage are not taxed. So unlimited amount of money. If Donald Trump gets divorced, and I guess he would undoubtedly have a prenup that would be ironclad, but if he didn't, if he gave half of his assets to his spouse, non-tax. There's no income tax and no gift tax. So it doesn't matter what the amounts are. That fundamental rule says if you are married or if you are ceasing a marriage, there are some timing rules toward the end of a marriage, basically some presumptions. I think I mentioned in the article about how long after a divorce this presumption continues to apply. But basically, it's a very easy rule to apply, covers everything, everything is tax-free.
As far as property transfer, you come up with some great examples here. A couple who, for example, own a house that they paid $200,000 for, and during the divorce, the house is transferred to the wife, but the value of the house now is $5 million, and so she has to assume the tax liability for the difference of $4.8 million.
Yeah, no, that's Scott. That's exactly right, and I think the notion that something is a tax-free transfer doesn't mean that you don't have to plan for taxes in the future. By that example, I'm trying to show that basically if you get the kind of newspaper story facts about a separation, a divorce, and you say, oh, they had $10 million and they split it even Steven, let's say it's a community property state like California, a long marriage, they split it even Steven, $5 million to one, $5 million to the other. Everything's fine. How could there be a tax issue? But you need to also know what the basis of the assets is, because, Scott, as you just said, if you end up getting $5 million of assets, as in that example, but the asset has a zero basis or a very low basis, then if you turn around and sell the asset, you're going to pay the tax. And that tax isn't divided unless you've thought to provide for that sort of thing in your divorce agreement.
We assume that Katie Holmes, would be asking for support and child support in this. How is that taxed?
Yeah, and of course the interaction of this is going back to the presumption of no tax on property transfers. Is something a property transfer or a property settlement, or is it alimony or spousal support? This gets discussed all the time, and the rule is maybe not quite as simple as I'm suggesting. The rule for alimony or spousal support is that if it is alimony, or also called spousal support, it's the same thing, then it's income to, if Katie Holmes is getting it, in this example, it's income to her, and it's tax deductible by Tom Cruise. So, again, this seems pretty darn simple. If you say X dollars is alimony or spousal support and Y dollars is property settlement, how could there be confusion? Well, first of all, there are some technical rules on alimony. For example, it has to be, it can't continue beyond someone's death and this kind of thing. It sounds a little silly, but people do mess this up. If you follow the rules, it's pretty easy to do it right. But people do it inconsistently. all the time the IRS audits people who've been divorced and they audit both sides, because what they find is that frequently someone who's receiving alimony thinks that it probably ought to be property settlement and therefore shouldn't be income. Someone that is paying property settlement sometimes thinks, gee, I'm paying all this money, it really is like alimony, I should be able to deduct it. So the IRS doesn't want to get whipsawed by this, so they audit.
Well, another great example of why people need professional help in these cases. Rob, always a pleasure. Thank you so much.
Thank you.
Rob Wood is principal at Wood LLP in San Francisco. He hosts the Tax Law Channel here on the Legal Broadcast Network.